Welcome to today's episode of the Simply Financial podcast. I'm your host, Christopher Calandra. Want to increase your financial IQ with today's episode, which is a mid-year economic update. I thought, given the success we had doing this in January at the beginning of 2023, that I would bring back a great guest, Jordan Jackson, Global Market Strategist at JP Morgan. As I said in the January version of this, JP Morgan, one of the absolute first class financial organizations in the country, probably the world. And the conversation with Jordan in January was very instructive. I got a lot of information, got wonderful feedback from my clients and listeners. So I thought it would be good now that we're halfway through the year, which, as a side note, the year seems to just be flying by for me. I don't know if you feel the same way, but to see kind of where we find ourselves at the midpoint of the year, what JP Morgan's outlook is as expressed by Jordan. Jordan, thanks for joining me today. I'm really excited about this discussion we're about to have.
Chris, thank you for having me back, and I'm looking forward to it.
So I thought we could start with one of the key topics, which is the idea of a recession. And it seems like we've been talking about the imminent recession for like a year and a half now. It's always seems to be just on the horizon, yet we don't seem to get there, although at least not get there yet. So can you talk a little bit about the position of JP Morgan as it pertains to whether we're going to go into a recession or not, how bad it might be, how short or long it might be? Can you provide a little color about the recession topic?
Sure, absolutely. And I can't have a client meeting without the dreaded R word coming up, certainly. Maybe if we could use the guide here and we could jump to guide slide 19 to talk a little bit about recession. I'd argue that the recession call, and to be candid, we've been calling for a recession, I think, since the beginning of the year. Generally speaking, I think back then, we had expected this recession to materialize sometime in the third quarter, and now it appears that the recession has sort of been pushed back, if you will, maybe a quarter or two. So we are still in a recession camp, that a recession is likely to materialize. Many of the leading indicators that we like to watch. And when I say leading indicators, those are financial indicators, things like the yield curve, and we can sort of get into that, so the spread between a 2-year bond and a 10-year bond. That typically signals a recession. Other leading indicators by way of survey data, so like purchasing managers indices, so PMIs, that signals a bit of weakness is likely to be ahead. But how do we know the recession is here? This slide is a great slide that we can have that conversation. These are the 6 key indicators that the National Bureau of Economic Research, or NBER, uses to determine whether the economy is expanding or whether it's contracting. So you've got real personal income, labor markets as measured by the non-farm and the establishment survey, real consumer and real institutional spending, and industrial production. Now, we like heat maps because we think it's a great way to visualize some of this data. So red being bad, green being good. You can see over time, obviously the pandemic recession, March and April of 2020, that deep red, the sharpest and deepest recession that we've had on record, followed by the very strong V-shaped recovery, the bright green, and all these 6 indicators. And now as you move to today, roughly about 4 out of those 6, which we show on the bottom half of this page, 4 of these 6 indicators are still in expansionary mode over the last 6 months. And we use the 6-month time frame because many people will assign 2 quarters, right, 6 months of negative GDP growth as a sign of a recession. And so we look over the past 6 months, and you can see again that 4 out of the 6 are still in expansion mode. So we're not in the recession yet, but we are seeing signs that under the weight of higher interest rates, the challenges with inflation, that the economy is likely to enter into a recession. And so that's still in our camp. We think that recession materializes sometime in the 4th quarter of this year. And it could very well be somewhat prolonged lasting 3 to 4 quarters, because we also think if a recession does happen, it'll be a fairly shallow one, not very deep and sharp like the pandemic recession.
That's good. I mean, my take on things is that the risk of a deep recession seems to have been reduced dramatically given the success that the Federal Reserve has had in bringing down inflation. It's down about 55% on the CPI over the last year. So, that kind of makes sense to me. It's not all negative, though. There is the specter of the recession, which, as I said at the top of the show, has been with us for a while. But we do have some aspects of the economy that have remained quite strong. Can we talk about some of them? Maybe talking about first the strong job market and also cover the relatively healthy consumer spending. Start with job market.
Sure. So for the job market, we can actually jump to slide 30 of the guide here. And this is the more holistic picture, I'd argue. Just looking at the unemployment rate, which is, I think, the kind of the broadest, most highly tracked measure of broader labor market tightness. That's in gray. And then you have wage growth for private production and non-supervisory workers. Now, we use this series. It may not match up the headline number. It's about 70% of the U.S. workforce, but they are typical clock in and clock out workers. So we think it's a cleaner measure on how to track wage growth. And you can see the unemployment rate as of May, 3.7%, sitting at multi-decade lows. And then when you look at the wage growth, certainly wage growth has started to come down a little bit, but it's still elevated versus that long run average of about 4%. We're running at about 5% year over year in wage growth. So we're in this weird labor market dynamic in which there's still this excess demand for labor that has yet to fully work itself out. One of the metrics that Chairman Powell and the Fed are closely watching are the number of job openings in the economy relative to the number of unemployed people. And that number is still sitting at about 1.6 times job openings per unemployed persons. And so, there's effectively more jobs than there are people who are willing and able to work. And that is creating this excess demand for labor that I think is keeping wages relatively elevated. And why is that the case? Well, if companies can't find that next employee, then they're likely going to have to try to pay up to either try to attract that additional employee or pay up in order to keep the employees that they already have employed on their books and continue to produce for the company. And so that's why you get this sort of stickiness in wage growth, and that wage number probably will continue to move lower, but it'll be gradually as this excess demand for labor continues to work itself out. So we're still very much in a tight labor market. One of the reasons why we feel confident that we haven't had the recession is because you've never had a recession and wage and the unemployment rate has fallen, and we've continued to see the unemployment rate come down, remain at very, very low levels. It is once we start to see that unemployment rate tick up, probably associated with the decline in wages, that'll be a clear sign that the recession is materializing.
How surprising is it, based on history, that the Fed is be able to bring inflation down? In June of 22, it was running, I think, 9.1%, certainly above 9. And in June of this year, it's at 4. Still has a ways to go, but a lot of progress has been made. How surprising is it that they've been able to accomplish so much, bringing down inflation, while still having a very healthy job market? It's pretty unusual historically, no?
It is pretty unusual, but I don't think it's necessarily a heroic efforts done by the Federal Reserve, to be quite honest, that's allowed inflation to come down. I mean, I think the bigger disinflationary aspects have come from the energy and the food components when looking at headline inflation. And actually, if we jump to slide 33, this is a new page in our guide that we're really excited about, but it highlights some of the numbers that you just referenced. So the left-hand side chart, you can see the contributors to inflation. As Chris mentioned, you've got that 9.1% year over year in June of 2020. That was that peak rate. And now you can identify, right, where that disinflation is happening. The green component, which was a big component of the inflation, about a third about a year ago, that's now in disinflation. So energy coming down pretty significantly. That's allowed for the headline inflation number to come down. Also, food, you can look at food at home. That was a big component that started to shrink a little bit. So all of this has really impacted the headline number. But what the Fed, you could argue, actually controls through interest rate policy is core inflation, or the demand side of inflation. And that's what we show on the right-hand side, the components. And you can see, while the headline inflation has come down pretty dramatically, core inflation actually hasn't come down all that much. I mean, it's down pretty meaningfully, peaking at 6.6% in September of last year. Now we're down at about a 5%. But take a look at what's contributing, interestingly, to this stickiness in inflation that the Fed seems to be obsessed with. And the core inflation measure that we're looking at actually excludes shelter, which is a large component, but it's a fairly sticky component. And what you can see is that red bar, transportation services ex airfares, has grown. It's continued to be a larger and larger share of that core inflation number. Now, what's in transportation services? It's car insurance, it's auto body repairs, and it's lease payments on cars. Now, what's really interesting, auto body repairs, this is a function of higher car prices. And so it's more costly to fix a car. Also, labor dynamics. We talked about this excess demand for labor. There's just not enough mechanics in the auto body shop to get these cars fixed in a reasonable time frame. So the cost of fixing a car has gotten a lot expensive, and that price continues to increase. What's interestingly, the Fed almost seems to be shooting themselves in the foot here by way of car insurance, which is that other one other component, and then lease payments. Both of those are tied to interest rates, which is what the Fed controls. Right. So the fact that the Fed is raising interest rates, and we can talk about how they're talking about, maybe raising rates another 2 times, they're almost contributing, right, to the inflationary pressures in this core CPI ex shelter inflation that they're so obsessed with. So I think the Fed is doing the best that they can with the tools that they have at their disposal. But I foresee this environment where headline inflation can kind of continue to come down, but core inflation, this measure of inflation that they're particularly worried about, maybe remains a little bit stickier than they'd like.
Very well said. And touch on the healthy consumer story. And I think it's related to this healthy job market. When people are employed, they tend to be more confident and more likely to spend. But the demise of the consumer is another thing, sort of like the recession, that's often talked about, rarely seen. All the time over my career, it's the consumer, if they stop spending, we're going to have trouble. But the consumer rarely stops spending. Can you talk a little bit about where we are with consumer spending and how that might be helping the economy? And perhaps you guys have a different perspective. I put fairly optimistic spin on that, but tell me about consumer spending.
Sure. Well, there's this old adage, a penny earned is a penny saved. Well, for the American consumer, a penny earned is a penny spent. So you're exactly right. If the Americans are employed and they're receiving an income, they will spend it. We are a spending economy. But if we jump to slide 25 in our deck here, we can kind of take a look at the state of, I think, consumers. And I'd argue that consumers are bending but not yet breaking. If you look at the top right-hand side chart, there's been a lot of literature put out coming out of the pandemic of all this excess money that consumers had amassed over the pandemic, just given added unemployment benefits, one-time checks that went out to millions of Americans. So we've been trying to track that excess savings relative to the pre-pandemic trend in overall savings, and that blue shaded region tries to capture that hump, right? That pop in overall savings numbers. And you can see that that number has come down. Consumers have been drawing down on that excess savings. Now, encouragingly, if you look at the bottom right-hand side, there's been a lot of talk about the nominal increase in revolving credit card debt. And certainly it is concerning right now, where consumers are sitting on about $1.3 trillion in revolving credit card debt. But I think what's really important is you should look at that number relative to disposable income. Yes, people can increase credit, but if their incomes are rising as well, then that's actually a healthy increase in credit usage. And if you look at the bottom right-hand side chart, we show revolving credit card debt as a percentage of income. Now, interestingly, prior to the global financial crisis in 2008, consumers were running at about a 9% credit to income ratio. That number continued to move down coming out of the financial crisis. I think consumers got a little bit more conservative after 08 and 09. Then you had that big increase in incomes generated by fiscal support. You saw that big decline, right at the pandemic in early 2020 of credit. So people use that extra income to pay down credit cards. Obviously, that number has started to rise, but I think this is more of a normalization in credit card usage relative to income, not necessarily consumers coming overextended. And so I think when you sort of paint the picture more broadly, savings are down, credit card usage is up. We are seeing consumers starting to come under a little bit more pressure. When we look at things like delinquency rates, they have started to move up modestly. And if you actually jump forward one slide to slide 24, the bottom right-hand side chart looks at 30-day delinquencies across auto loans, credit cards, and student loans. Again, as of late, you can see that modest move higher, but certainly not in delinquencies where we were coming into the financial crisis. So again, I think consumers are bending, not yet breaking. The tight labor market, higher wage growth. If we're in an environment where inflation is coming down, which we talked about, and wages remain fairly firm, we could be in an environment in which real wage growth turns positive. And that tends to be very, very healthy for broader consumption. And given consumption accounts for about 2/3 of overall economic activity, the consumer can kind of hum along here potentially, even if the broader economy, other aspects of the economy start to come under some pressure.
In summary, Jordan, looking at this data, and you might just be listening to what we're talking about, it seems like, from historic, and let's just say since 2000, all right, maybe the numbers are not as great as they were during the the pandemic, I should say, where savings rates spiked, and but still, I mean, the consumer is not really overstretched, and none of this really jumps out to be the thing that drives us over the edge. It seems like it's well within the norms. Is that a good summary?
I think that's totally fair. And, the reality is we're getting a lot of questions and this almost reverts right back to where we started the conversation on the recession call. Well, if the consumer kind of hangs in there, where's the recession going to come from? And I draw parallels to the early 2000s in which you had a more business-driven recession. Corporate CapEx really came down after you saw a lot of research and development spending leading up to the tech bubble. And so you saw a CapEx, which is about a 15% chunk of the overall economy, really come down. That drove the very modest recession of the early 2000s. Interestingly enough, real personal consumption remained positive through that recession, and the unemployment rate only moved up to a modest peak 6.3% in June of 2023. And we're talking about, again, still very low levels of unemployment today, maybe a modest move higher in the unemployment rate in a recessionary environment. So, we've been in recessions in which it's been more business capital spending driven recessions, whereas the consumer, kind of hangs in there. I travel across the country, and whenever I pose a question to the audience and say, how many folks have a vacation planned over the next 6 months, about 80% of the room, the hands go up. And for me, that's a sign that, again, consumers are, sort of still hanging in there.
Yeah, I would agree. I know some talking heads out there, they think that because there's been an uptick in some of these consumer category, that it means the end of times. I'm half joking here. But it just seems like I said before, that we're well within the norms. It seems to me another key part of this is corporate earnings. US corporations, it seems to me, continue to be dynamic and have really negotiated through these difficult couple of years with a lot of changes, high number of challenges, but they seem to be in good shape. Can you talk a little bit about JP Morgan's outlook on that front?
Sure. We like to use slide 8 in our presentation to talk about the corporate earnings backdrop. So yes, corporate earnings have been, I'd argue, a bit more resilient than what we initially anticipated. So the left-hand side chart just shows index earnings for the S&P 500, so the 500 largest companies in the US. And then the right-hand side chart breaks down that earnings per share growth by margins, revenues, top-line revenue growth, and share count, which is a fancy way of saying buybacks. Now, one of the challenges that we have in our outlook, if we're talking about a recession, albeit a modest recession, earnings tend to be hypercyclical, meaning that they move to a greater degree, either up or down relative to the economy. And so if we're talking about slower growth, then in our view, that would suggest that earnings should contract over the course of 2023, and in particular over the next 12-month time horizon. But what's interesting, going back to that left-hand side chart, those blue bars on the right-hand side show the next 3 years projected earnings per share growth from bottoms-up analysts. So what analysts expect earnings to do over the next 3 years. Now you can see that modest contraction, about 5% contraction in earnings in 2022. Again, that's sort of a reflection of margins contracting, right? With higher costs, higher supply chain issues, all that really impacting margins. But what I'm concerned about is those 3 bars, the dramatic step up in those 3 bars over the next 3 years. And what that would suggest is 2024, markets are anticipating close to $250 earnings for the S&P 500. That would suggest a blend, if we're talking about a blend, so half of 2023 and then the first half of 2024, that would suggest a dollar earnings of about $235 over the next 12 months. And we think that's just too optimistic, right? That's effectively calling for about 11% earnings growth, a little bit higher than 11% earnings growth over the next 12 months, and then about 11% earnings growth for the calendar year 2023. Again, if earnings are hyper-cyclical and we're expecting this recession or a slowdown in growth, we think earnings need to be roughly flat to slightly negative this year. And that's a bit out of consensus. We've actually seen earnings being revised higher over the month of June in terms of forward earnings expectations, but that's where we're a little bit more conservative, we'd argue, than the broader market.
Yeah, so it seems like there's optimism, and I think it ties into what we talked about earlier. Earnings estimates are reflecting the idea that the Fed is going to be successful and engineer a soft landing where they are able to, and again, some of this is able to get inflation under control without undue damage to the economy and sort of landing the economy safely. It seems like the thesis that the Fed would engineer a soft landing, and I did a Simply Financial podcast episode on this not too long ago, Jordan, and it was titled Dreaming of a Soft Landing. But is it fair to say that some of this optimism is tied to the idea that the Fed's going to be able to engineer a soft landing?
Absolutely. The idea that growth is going to stay intact. Consumers, as we talked about, they bend, but they don't break, so they continue to spend. That tends to be positive and good for corporate profits. And the improvement in supply chains means that the cost on companies comes down as well. Some stabilization in oil prices, right? That feeds through to margins and costs as well. And then also the last point that I would make is technology is now 30% of the index, but also 30% of the earnings. in this AI craze in which, certain companies have announced that they're going to be, huge beneficiaries of this pickup in AI and chip development and semiconductors and all that. Potentially all that earnings growth materializing in 2024, and markets are looking ahead, right? They're looking ahead
Yeah.
toward, that positive tech earnings really coming through in 2024. And I think they're pulling forward some of those returns, which is why you've had the market, really price in, at least over the first 5 months of the year, a small subset of names, companies that were really driving the index higher. Now you've got a bit of a broadening out in terms of performance and other sectors participating in that performance over the month of June. But I think all the things that we've highlighted, a soft landing, earnings tied to artificial intelligence materializing in 2024, less margin pressure hitting companies next year, and all that, I think, helping to kind of boost some of these earnings projections through the back half of this year and into next year.
Thank you. So that moves us where I wanted to go next. So Wall Street estimates for corporate earnings are more optimistic than JP Morgan would necessarily think.
Yep.
And that brings us to the Federal Reserve, which we've already talked about a bit. And I talked about this soft landing, the idea that they're going to strike the balance between reining in inflation and not doing undue harm. But there's a risk, and I think it's not a small risk, that the Fed ends up being too aggressive and does do more damage than is needed. It's a tricky proposition. I wouldn't want to be a Federal Reserve governor, or maybe I would on the pay and prestige front, but they got a tough go of it, right? So can you talk a little bit about JP Morgan's view on the risk of the Fed being too aggressive?
Sure. If we could jump to slide 36 in the deck here. So the Fed has come out. They've already hiked interest rates to 5 to 5.25%. They paused at their last meeting. They said they wanted to assess the amount of tightening that they've already done and how that's impacting the economy. But it was what we would call a hawkish pause, or a hawkish skip, I would say, meaning that they plan to pause, not hike rates in June, but they are gearing up potentially to hike rates again in July. They've also highlighted that they potentially see 2 more rate increases over the course of this year, and maybe embracing this pause, hike, cadence, in which, again, they'll hike in July after pausing in June. They'll then pause in September and then hike again in November. That's sort of what they've highlighted to the market. Now, the dark blue diamonds to the far right-hand side of this chart shows exactly what the Fed is signaling. They're signaling, again, those 2 more hikes over the course of this year, but then they're anticipating cutting rates 4 times next year, and then another 6 times in 2025. So again, gradually reducing rates. Now, I'll give you all a very tangible example of the challenges and how higher rates weighs on the consumer. I moved to DC in early 2021. I was able to lease my car, 3-year car payment for about $400 a month. So due April of next year, I'm going to be in the market again to either lease the same car for another 3 years, or again back in the market. I mentioned my lease payments now are $400. Where lease rates are at today and where car prices are at today, that same car that's now $400 would jump up to about a $750 payment. And so you can see how aggressive rate increases directly are going to start to impact, the consumer, again, by things like car payments, by the APRs that we pay on credit cards. And so the Fed continued to be aggressive in raising rates. That is what potentially, again, sort of tips the economy into recession, weighs on consumer spending, right? Because it increases the cost, right, of living, the cost of credit. It increased the businesses' cost of doing business. In July of 2020, a short-term business loan was about 4%. You think about small businesses having to tap those lines of credit. Last month, that number was 8.5%. So now credit becoming twice as costly for small businesses across the economy. So, you paint all this picture, higher rates weigh on overall economic activity, and the more aggressive that the Fed tries to be with raising interest rates, the greater the risk is that they cause a deeper contraction in the economy.
And would you agree with my assessment that they're in a tricky position now with, given the executive branch's prescriptions combined with the unusual circumstances in this post-pandemic economy that we find ourselves in. And it's always difficult being a Fed governor and being the chairman of the Fed like Jerome Powell is now, but it seems like they have a particularly difficult decision-making pattern to try and deal with.
No, absolutely. They're walking a tightrope. And they've got two mandates. Their two mandates are maximum employment, which we've talked about. You could argue we're there, the unemployment rate at 3.7%.
Yeah, I would agree with that.
And price stability by way of inflation. And we've talked about how the headline inflation number is going to come down whether the Fed is active or not. I mean, a lot of that headline inflation coming down is, again, as we've talked about, being driven by energy and food, which interest rate policy doesn't have a huge impact on. But the stickiness in the measure that they're focused on, again, we've talked about, they may be shooting themselves in the foot by continuing to raise rates. And so where they would need, where that inflation pressure could come down more meaningfully is if they cause that pain in the economy, that pain in the labor market, that pain in demand on both consumers and businesses under the weight of higher rates, that helping to get inflation down. I think the committee is almost kind of struck or just obsessed with this 1980s inflation, Volcker inflation. Yeah. When inflation shot up, they were a little bit cautious with raising rates, and they paused, and then inflation came down a little bit, but then it shot up again, and that dented the Fed's credibility as an inflation fighting entity. And I think they're very much focused on their credibility as an inflation fighting entity today as well. And they're prioritizing the inflation numbers. They're prioritizing that year over year CPI run rate. And by prioritizing that, they run the risk of raising rates too much and causing more pain in the economy. So it's again, I wouldn't be I'm with you, Chris. I wouldn't want to be a Fed governor conducting policy today.
Yeah, I don't know how much they must make a bit of money, or maybe not. Is it more like public service kind of thing?
Yeah, I think Fed official salaries are publicly available. I think Powell makes something like $180,000 a year.
Oh, that's not. I mean, in the world of finance, I mean, that's a good living. I understand, but in the world of finance, that's not. But then he'll write a book and do the speaking tour and all of that good stuff when the time comes. I wanted to ask you a little bit, and I don't know if I don't recall if there's a slide on this, but it still seems to me, let's just talk about, just sentiment a little bit. As of this recording, the markets enjoyed a nice rebound. The fourth quarter of last year, stock market averages, let's use the S&P 500, staged a nice rebound after 3 really difficult quarters to start last year. And then this year has been good. Very strong, including the month of June, possibly in reaction to the debt ceiling deal being struck. But it seems to me, despite the markets having a rebound, I don't know what adjective you'd want to put in front of that, it still seems like people are pessimistic and there's a lack of confidence. It seems like the American public are still kind of in a bit of a sour mood. Can you talk a little bit about how that plays into the things we've discussed? Inflation, the Fed, the job market, consumer spending. It seems to be a part of this, but it's difficult to kind of sort it out, because I've been joking, Jordan, that, you go to a nice 5-star restaurant, and I like to spend money on a nice meal out, and you observe a table next door, and it might be, let's say, 3 couples, and they're spending a lot of money on food and wine and all these different courses, and yet they're complaining about inflation and the state of the economy.
Yeah, it's really interesting, and you almost teed up one of my favorite slides in this deck. It's slide 27, and it looks
That's because I'm a great host, or it was just an accident. But either way,
and so what it effectively shows, and we've got a nice decent amount of history going back. It shows consumer confidence, one of the most well-tracked measures of consumer sentiment and confidence, University of Michigan's consumer sentiment. And what's interesting is what we've done is we've highlighted both peaks. So when consumers are almost euphoric, they're very, very confident and excited about the job market, prices throughout the economy, their ability to get a job, et cetera, et cetera. We've highlighted the peaks in consumer confidence, but we also highlighted the troughs in consumer confidence. And what's interesting, if you look at the most recent trend, consumer confidence really troughed in the middle of last year. And that was when, remember, gas prices were, over $4 a gallon. We were now, roughly 3-4 months into Russia's invasion of Ukraine. And there was just a lot of uncertainty.
right. And that was also peak inflation, right? I mean, unless something dramatically changes, that was also peak inflation June of last year.
Yep, exactly. And so what you saw a bottoming out in consumer confidence middle of last year, and that has started to recover a bit, but we're nowhere near sort of that long run average level of consumer confidence. Looking at this index, about 85 right now, consumer confidence is about 64.4. So we've recovered a little bit, but certainly not back to sort of average, and consumers aren't feeling great. But I think part of what's allowed that improvement is gas prices, inflation have broadly come down over the last 12 months. I don't want to say stability in Russia, Ukraine, but consumers have gotten sort of used to
Yes.
sort of the state of affairs in Eastern Europe. And then lastly, the labor market, as we talked about, remains tight. I think we're still in an environment if you want a job, you can go out and find and get a job. And that generally leads to an improvement in broader consumer confidence. But what's interesting is it almost appears to be that consumer confidence is a contrarian indicator. Now, when I say contrarian, meaning that kind of like the Warren Buffett adage, you want to buy when everyone is fearful, and you want to be greedy when others are euphoric. And so when consumer confidence troughs, you tend to see pretty strong 12-month performance coming up from equities. On average, we've looked at troughs in consumer confidence. The subsequent 12-month return has, on average, been about 25% in the market. But if you were to be buying when consumers are feeling great and almost euphoric, so consumer peaks, that average return over the next 12 months is only about 3.5%. So if you were to buy the market when consumers felt really crummy in the middle of last year, you've actually would have benefited from about a 17.5% return by owning equities when consumers felt really, really bad.
Yeah,
I think that
makes sense. I'm sorry to step on you. It kind of dovetail what we've been talking about here at LA Wealth Management with our clients since July kind of time period last year. Concept of the wall of that the market has a tendency, when confronted with bad news, especially a lot of bad news, which we had a steady diet of the first portion of last year, can climb the wall of worry and mount a rebound and make progress as it climbs the wall of worry. And that seems to dovetail what you just explained with my discussion about the wall of worry and that being a cause for optimism. Does that make sense?
Yeah, there's sort of the wall is maybe a little less thicker, or maybe a little shorter of a wall. Now we've gotten past the debt ceiling. I guess the next sort of area of concern, maybe we're going to be into the election season, and so we're going to probably have another 12 months between the end of the year and through 2024. Politics being back to front and center.
Yes.
But generally speaking, I think consumer confidence can continue to improve so long as the labor market continues to remain intact. I don't think we'll get to a euphoric sort of position because there's still a lot of uncertainty around the economy more broadly. But I think again, consumers can kind of sort of hang in there here.
And the other point I'll make related to this is what caught my attention is this I don't know if popular is the right word, but this survey, right track, wrong track. It basically simple. They poll, ask Americans, do you think the country is on the right track or the wrong track? The most recent report on this was that only 2% of Americans thinks the country is on the right track. So I took note of that both as a citizen, right? I mean, this is we're recording this right after the 4th of July. I mean, it's a great country. I love our country. We have issues that need to be dealt with. It's a little upsetting that only 20% of the country thinks that we're on the right track, and I there's ramifications politically, but I'm curious as to if that's a worrisome aspect for the economy and perhaps the markets, or is it maybe contrarian? Because if you could drive that 20% number up to 25 or 30 or 40 over the next stretch, might that translate into better economic performance and help drive markets higher? Do you have an opinion on that?
I think it's a great question, an interesting one to think about. I'd argue that to some extent, because consumers broadly, from an economic perspective, there's a certain immediacy, right? In terms of if I have a job, I'm getting paid weekly or bi-weekly. I'm still able to spend, right? I'm still able to do the things that I need to do. So a lot of I think what you're hinting at are elements in the background, right? Things that could shift, I'd argue, maybe the political landscape over the next 5 to 10 years. It shifts election outcomes. It shifts how the political agenda in which we're going to focus on in terms of politicians marketing and looking to get reelected, and how they market to their constituencies. It potentially has impacts on things like the deficit and where we're spending as a government, particularly when we look at non-defense discretionary spending. And so, all that are things that sort of happen in the background, and I think have longer term implications for things like fiscal policy, primarily fiscal policy. But I think the more immediate dynamic, again, is a healthy labor market. Folks feel like they can pay their bills and potentially then some to enjoy experiences and services and buy stuff. So while consumers are still don't feel great, they're not as sour as they were in the middle of last year, but they're not as euphoric as they were prior to the pandemic.
Wonderful. Leave it there. Jordan Jackson, Global Market Strategist, JP Morgan. I'm so appreciative you joined me again after us doing a version of this in January. Thanks for your time. I'll leave it there, but please thank your associate Bill Menaggio for me too for setting this up.
Will do. Thanks for having me again, Chris, and let me know if you need me.
All right. Good luck the rest of the year.
Thanks.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.